Most investors think 2026 will simply extend the trends of the last few years. Lower inflation, slower growth, fewer surprises. That assumption is dangerous, because markets don't change when headlines change. They change when expectations break. And heading into 2026, expectations are more fragile than they look. Most conversations about 2026 are focused on the wrong questions. People are asking whether rates will come down faster, whether growth will slow or reaccelerate, whether stocks will keep rising or finally correct. Those questions sound reasonable, but they miss the point. Markets don't move based on what might happen. They move based on the gap between what's expected and what actually occurs. Right now, expectations for 2026 are unusually narrow. Investors are assuming stability, predictability, a continuation of trends that already feel familiar. That kind of consensus doesn't remove risk, it concentrates it. And when expectations become concentrated, even small surprises can have outsized effects. That's why understanding 2026 isn't about guessing outcomes. It's about understanding where the assumptions are and what happens if they're wrong. On the surface, the outlook for 2026 seems relatively clear. Inflation has come down from its peak. Economic growth is slower, but still positive. The labor market has cooled without collapsing. From that, a broad consensus has formed that interest rates will gradually come down, that volatility will fade, and that markets will be rewarded for patience. This view isn't unreasonable. It's supported by recent data. It's reinforced by central bank messaging. And it's echoed across financial media. As a result, many investors are positioning for a future that feels manageable. A future where shocks are smaller, where outcomes are more predictable, where the path forward looks smoother than the past few years. But markets rarely reward what feels comfortable, because when a view becomes widely accepted, it gets priced in. And once something is priced in, it stops being a source of upside and starts becoming a source of risk. The part of the market most people aren't watching right now isn't inflation or interest rates. It's positioning. Specifically, how capital has been allocated based on a shared set of assumptions. Over the last few years, investors have gradually aligned around the same narrative. That uncertainty is fading, that policy risk is declining, and that the biggest threats are already behind us. That belief shapes behavior. It influences where money flows, which strategies feel safe, and which risks are considered acceptable. The problem isn't that this narrative is wrong. The problem is that it's crowded. When too many portfolios are built on similar assumptions, the market becomes fragile, even without bad news. Because fragility doesn't come from weakness, it comes from imbalance. If expectations are high and positioning is one-sided, the market doesn't need a shock to reprice. It only needs something to be slightly less good than expected. That's the mechanism most investors overlook. Risk doesn't appear when conditions deteriorate. It appears when reality fails to match confidence. And heading into 2026, confidence is doing more of the work than fundamentals. A simple way to understand this is to think of the market like a structure. It doesn't fail when everything looks weak. It fails when pressure builds in places people stop checking. Imagine a bridge. When traffic is heavy, everyone notices. When traffic is light, no one worries. But the bridge doesn't collapse because of the cars. It collapses because of stress in the supports. In markets, expectations act like those supports. When expectations are modest, markets can absorb bad news. When expectations are high, even good news can disappoint. That's why volatility often appears during periods of apparent stability. Not because conditions are terrible, but because outcomes fall short of what investors have already priced in. Heading into 2026, the structure matters more than the surface. The question isn't whether growth continues. It's whether growth meets the level of confidence already embedded in the market. This is where small changes start to matter. If economic growth slows just a little more than expected, if earnings miss by a narrow margin, or if financial conditions tighten slightly faster than markets anticipate, the issue isn't panic. The issue is adjustment. When expectations are high, markets don't react proportionally. They react asymmetrically. Positive surprises tend to have limited upside. Negative surprises create outsized moves. That's how volatility returns, not through crisis, but through disappointment. And that dynamic is especially relevant going into 2026, because the margin for error is thinner than it appears. When confidence is elevated, flexibility matters more than conviction. When this kind of environment takes shape, outcomes start to diverge. Assets that rely heavily on momentum tend to struggle first. Strategies built on predictability become more fragile, and areas priced for perfection lose their margin of safety. At the same time, not everything suffers. Periods like this tend to reward flexibility. They reward balance, and they reward investors who understand where expectations are low, not just where growth is high. This doesn't mean avoiding risk altogether. It means recognizing that risk is no longer evenly compensated. In 2026, the difference between success and underperformance won't come from taking more risk. It will come from taking the right kind of risk in the right places at the right time. Markets don't punish optimism. They punish overconfidence, and they reward preparation. The goal heading into 2026 isn't to predict every move the market makes. It's to reduce fragility. That starts with understanding where assumptions live inside a portfolio. Which outcomes are you relying on? Which trends need to continue? And how sensitive are your positions to disappointment rather than disaster? In an environment like this, flexibility matters more than precision. That means avoiding strategies that only work if conditions remain perfect. It means being cautious with concentration. And it means leaving room to respond when expectations shift. This isn't about becoming defensive. It's about being adaptable. Because markets don't announce when regimes change. They signal it quietly, through behavior, not headlines. The investors who perform well during these transitions aren't the ones who predict the future correctly. They're the ones who prepare for multiple outcomes and adjust early. In the next video, we'll take this one step further. We'll break down the specific indicators that tend to move before markets reprice expectations, not the ones that dominate headlines, but the signals institutions quietly monitor when positioning starts to matter more than news. Understanding those indicators is how investors spot regime shifts early, before volatility becomes obvious. If you want clear, no-hype analysis on where markets are heading and how to prepare for it, consider subscribing. New videos every week, focused on what actually matters.